Okay, now we're on our third mini lecture for Chapter 9, and I wanted to point out that we will not be covering asset impairment on the financial statements. That's not part of our SUNY learning outcomes at this point, and because we have so much to cover this semester, we're not going to be covering that. Okay, so we are going to move on to learning outcome 9-5, analyzing the disposal of long-lived tangible assets. Okay, so the disposal means we're going to be getting rid of the asset. We might be selling it or we might be scrapping it. If an asset is disposed of before it is fully depreciated, two accounting adjustments are made. First of all, we update the depreciation expense and the accumulated depreciation accounts. What we would do is we would do a depreciation entry for the partial year's depreciation. In other words, the depreciation for the portion of the year that has not yet been recorded. Then we would record the disposal of the asset. We would have to get rid of the book value, which means both the asset and its associated accumulated depreciation accounts. And we would record the value of any items received, usually cash if you were going to receive anything. And then the difference between the amounts, the value of the assets received versus the book value of the asset given up, would be recorded as a gain or loss on the disposal of that asset. So in our example, assume that an asset with an original cost of $100,000 was sold for $50,000. So let's compare the cash that you're receiving. Cash received was $50,000. And you're comparing that to the book value of the asset that you were selling. Well, it said that the original cost was $100,000 and the accumulated depreciation was $60,000. Book value is cost minus accumulated depreciation, or $40,000. So you're receiving $50,000 for something that was worth $40,000 on your books. Therefore, you made a gain of $10,000. We would record the sale by debiting cash for the amount you received, debiting accumulated depreciation for $60,000 because it would normally have a credit balance. By debiting, you're zeroing out that account. Crediting equipment for its original cost. That account normally has a debit balance, so by crediting, you are zeroing it out as well. And then crediting gain on disposal for the $10,000. Now, what if that asset with original cost of $100,000 was scrapped? I apologize because your notes probably say scraped, but it should say scrapped. The asset has accumulated depreciation of $60,000 and a book value of $40,000. Well, in this case, the cash received would be $0 versus a book value of $40,000. So you're receiving nothing for something that was worth $40,000 on your books. So we won't be able to debit cash. We'll debit accumulated depreciation for that amount to zero that account out, and we'll credit equipment for $100,000 to zero that account out, and we will debit loss on disposal for $40,000. Now let's take a look at a few problems. In M-9-9, the following transactions are transactions of Morel Corporation. First, let's do A. Morel Corporation disposed of 2 computers at the end of their useful lives. The computers had cost $4,800 and their accumulated depreciation was $4,800. No residual value was received. It also doesn't say anything about cash, so they're not receiving any cash. I'm going to put the balances of those 2 accounts in the T accounts I've created, and I apologize. Normally I would put accumulated depreciation before equipment, or after equipment, but unfortunately I had more room on the right side here. So let's put $4,800 for the computers in the equipment account on the debit side because that's an asset account. And the accumulated depreciation account is a contra asset. It has the opposite type balance, also a balance of 4,800. Now when we go to record the gain or loss on this account, let's compare the cash received versus the book value. In situation A, it says nothing about receiving any cash. They're just disposing of computers at the end of their useful lives. So the cash received was 0. The book value is the cost of the equipment minus the accumulated depreciation, or 0. So there is no gain or loss in this situation. We're simply going to do the opposite of these two accounts to record taking both of them off of our books. So we're going to debit accumulated depreciation for 4,800, and we're going to credit equipment for 4,800. And if we post these, a debit to accumulated depreciation and a credit to equipment, we'll see that both accounts now have a 0 balance. Now on to part B. Assume the same information as A, in other words, accumulated depreciation of 4,800 and equipment originally costing 4,800, except that accumulated depreciation updated to the date of disposal was 3,600. I apologize. This should be 3,600. Okay, so now let's do the calculation to see if we have a gain or a loss. The cash received is still 0. The book value, which is the cost of 4,800 minus accumulated depreciation of 3,600, the book value is 1,200. So you are receiving no cash for something that's worth 1,200 on your books. Consequently, you have a loss of usefulness of those computers. You have a loss on disposal. So we would record this by doing the opposite of the equipment and accumulated depreciation accounts. Debit accumulated depreciation for 3,600. Credit the equipment account for 4,800. And the $1,200 loss will go on the debit side. Losses are like expenses and gains are like revenues. Gains are credited, losses are debited. And this is considered a loss on disposal. The debits equal the credits. Now let's take a look at M9-10. Okay, in problem M9-10, as part of a major renovation at the beginning of the year, Adiace Pharmaceuticals sold shelving units recorded as equipment that were 10 years old for $800 in cash. The shelves originally cost $6,400 and had been depreciated on a straight-line basis over an estimated useful life of 10 years with an estimated residual value of $400. Assume the depreciation had been recorded to the date of the sale. Show the effect of this disposal on the accounting equation. In our case, we're actually going to be doing the journal entries. Okay, so normally to calculate a gain or loss, we would compare the cash received, which we know is $800, versus the book value. To find book value, we take the cost and subtract the accumulated depreciation. The problem is, this problem doesn't tell us what the accumulated depreciation is, so we have to calculate it, which is why I have the straight line depreciation calculation here. Let me zoom out just a bit. There we go. Okay, so let's apply the formula. The cost was $6,400. Estimated useful life 10 years, residual value of 400. So 6,400 minus 400 is 6,000, and we're going to multiply by 1 over the useful life of 10 years. 1/10, and that gives us depreciation annually of $600. Now, this problem said that they had been depreciated over its 10-year useful life. They are 10 years old at this point. So 600 times 10 years gives you $600 in accumulated depreciation. So if I wanted to figure out my book value, I would take the cost of $6,400 minus accumulated depreciation. 600 times 10 years is 6,000. So subtract out accumulated depreciation of 6,000, and my book value is 400. So I'm receiving $800 in cash for something that's worth $400 on our books. We're receiving more than it's worth, so we have a $400 gain. So let's record the disposition of that asset. We're going to debit cash for the amount of cash received, which was $800. We're going to debit accumulated depreciation for the amount that we calculated, $600 a year, times the 10 years that those have been around, or $6,000. We're going to credit the equipment, which is the shelving, for the original purchase price. And then finally we will record the $400 gain on disposal. And remember, the way we calculate a gain is we compare the cash we're receiving to the book value of the asset, which is cost minus accumulated depreciation.